kick off now. Hi everyone, and welcome to QuotedData's weekly show. Hope you've had a good week. For those who don't know, I'm Jane Arana and I'm an analyst here at QuotedData, and I'll be hosting today's show where I'll also be joined by my colleague, Richard Williams, and our special guest, Richard Pinder, who is co-founder and CEO of Literacy Capital, which I'm sure you've heard a lot about since it listed earlier this year. As always, we'll be kicking off with the weekly news roundup, where I'll be talking about EP global opportunities and yet another potential IPO from Atara Onsite Energy. And our resident property analyst, Richard, will then talk to you about urban logistics REIT. So first of all, EP global opportunities. Before we talk about what's going on, just a little bit about the trust. So it's just over 100 million in size, and it sits in the global sector and is managed by Dr. Sandy Nairn of Franklin Templeton. So it was hit early last year in the wake of COVID, as many other trusts, but it's bounced back somewhat, and though it hasn't quite gone back to its pre-pandemic levels, it's on its way there. And similarly, as you see at the discount, it's rarely gone back to single digits since the pandemic, but it's nowhere near the levels it was at the peak. So just taking a look at it amongst its peers, it's one of the smaller trusts, as I already mentioned, and it's on a double-digit discount. But in terms of yield, it's actually mid-table, offering a respectable 2.11%, which I think, given today's environment, a lot of people looking for income, that's actually quite attractive. So what's actually going on? On Monday, the trust announced plans to become a self-managed trust. Now, this follows a review of the strategic direction, which EP Global Opportunities said it would be doing back when it released its half-year report in June. What does this mean? The board will assume overall control over the investment policy and will have overall responsibility of its activities. They've proposed that they'll still have Dr. Sandy Nairn as manager, who will be appointed as director and will have responsibility for day-to-day investment management. And they've also entered heads of terms with Franklin Templeton, where Dr. Nairn has agreed that he will carry on working at Franklin Templeton and will be responsible for a new sub-advisory arrangement with EPG and Franklin Templeton. Of course, this is all conditional to shareholder and FCA approval. The board also wants to amend its investment objective and policy, which will involve expanding its investment objective of providing shareholders with an attractive real long-term total return. This will include investing globally in undervalued securities by enabling investment in other financial assets. And the board also wants to amend the investment policy to permit investment in diversified portfolio of equity and equity-linked securities, both in the listed and ungraded space. So while the board believes that most shareholders will want to maintain their investments in the trust, it also realises that some might not. And so it released more information about a tender offer today. This will include up to 20% of shares of the company at a discount of 2% to NAV per share, and shareholders are entitled to tender up to 20% of their holding. Again, this is conditional to shareholder approval. So I don't know if any of you've seen in our article that we covered this story earlier this week. My colleague James did actually say this is quite an unusual move. Self-managed trusts are vanishingly rare, especially now as Scottish Investment Trust, which we talked about last week, actually had plans to combine with JP Morgan Global Income and Growth. So there's clearly a desire to go the other way with some trusts. Now, this could also pose potential problems because with a market cap of just 101 million, EP Global Opportunities is already on the small side, and so a decent sized tender offer could make things worse. This could cause further problems because while self-managed, EP Global Opportunities will have to still cover the same sort of conditions, and it won't have the backing of a bigger firm to help cover that, and things could get quite disproportionately expensive. And in that case, it makes sense to outsource the management of parts of the portfolio through investment to other funds. So talking on to our second story, Atara Onsite Energy, which is another plan for an IPO, and once again in the renewable energy infrastructure sector. So this is a new closed investment company established to invest in a diversified portfolio of on-site renewable energy assets. The trust plans to trade under the ticker ROOF and is targeting 150 million. Also targeting an annualized dividend of 5p per share for the first and second financial years, and then seek to grow the dividend progressively thereafter. And it's also targeting an annual total return of 8 to 10% in the first financial year following the IPO and over the medium term. So just looking at the renewable energy infrastructure sector as it is, there's already quite a few trusts in this sector, and 9 of them launched in the last 2.5 years, 3 of them this year alone. There was also a potential IPO from Blackfinch, as you might remember, earlier this year, but that one failed to go ahead. So it's already quite a busy sector, but then this also suggests that there's a lot of demand there and opportunity. So what makes Atara Onsite Energy different? It says it has a differentiated strategy in that it's dedicated to on-site energy, which is something that hasn't been done before, or at least not to this extent. It offers low power price sensitivity, and it's making use of a lot of the thematic plays going on at the moment, such as the contribution to the UK's net zero transition. It also says that it is an ESG leader, and it will be playing alongside the electricity demand. The thematic play in that electricity demand is forecast to double. So the UK is forecast to need twice as much electricity in 2050 versus 2019, driven by the requirement to decarbonise primary energy consumption, such as heating, which makes up more than 1/3 of total UK greenhouse gas emissions, and transport, which accounted for 27% in 2019. It will also be playing on the solar theme, which is a key part of the solution. The forecast growth in electricity demand and requirement to reduce greenhouse gas emissions means that new low or zero carbon sources of power generation are essential. It's also following corporate sustainability goals. So corporates are under pressure to achieve sustainability goals, and the use of zero carbon electricity is a fundamental contributor to their emissions reductions. Atara says that 45% of FTSE 100 has committed to net zero or carbon neutrality, and many have targets ahead of the UK's national timeframes. So, as we already know, one of the trusts in this sector did fail to go ahead earlier this year, but out of all the ones that tried, 3 also got through. So we don't know where this one's going, but it'll be interesting if it does, and interesting to see whether it reaches its target, which is also something that a lot of the new trusts have struggled with recently. And I'll now pass you over to Richard to talk about urban logistics REIT.
Great, thanks, Jonah. Yeah, so big announcement from Urban Logistics this week that they were moving from the AIM market to the main market of the London Stock Exchange, which would be really good for them. They've basically outgrown the AIM market. Certainly in the last, or specifically in the last sort of 2 years, probably, they've done many capital raises and grown the size of the fund. So it makes complete sense that they move over now, and the advantages are huge for them. There's obviously a greater pool of capital looking at on that market, and so the liquidity in shares will grow, or you think would grow, and broaden the share register. And so they're looking. Well, they've got a general meeting on the 12th of November, and they're hoping to admit on the main market on the 7th of December. So if we look at their performance since they were launched, so they've been going about 5 years. So on the next slide, Jane, if you could put that across. So yes, so they were launched in 2016, and quite a slow burner in the early years. But like I said, since 2019, and then certainly since last year, they've really kicked on. Market cap's now 577 million. They're at a healthy premium, and they've, like I said, been doing a lot of capital raising. to grow the fund, and this sector is obviously one of the property sectors that has done really well during the pandemic. Logistics is huge now with online retailing and supply chain issues now bringing manufacturing and things like that back to sort of Europe and the UK. Inventory has grown, so demand for logistics space is massive, and supply is really short. So we're seeing this big sort of crunch where rents are going massively up due to the supply and demand dynamic. And the urban logistics sector, which is the smaller smaller properties which are located close to town centres and city centres, doing the sort of last mile parcel delivery stuff, basically, that sector is even more supply constrained. So yeah, real growth potential there for urban logistics. So we go on the next screen. There's other things they're looking for permission from investors at their general meeting in a couple of weeks. So they've made a few small changes to their investment policy, and this is more as they grow. They've made these. They're very small. So their average lot size now is 15 million instead of 10 million, and they brought their target LTV down as well to between 30 and 40% instead of 45. But the main one that I can see in there is that they're looking to introduce speculative development up to 10% of their gross assets, which they don't have that in their investment policy at the moment, and that makes sense given what I said about the supply demand dynamics in that sector. The returns in development will be massive, and they also looking to permission for a placing program of a maximum of 350 million shares or C shares. And they also announced their trading update, which the highlights are on the next slide, which just shows how big this sector is and how quickly this company is growing. So almost 100% occupancy in their 91 logistics properties, rent collection just under 100%. That hasn't been a problem throughout COVID, unlike other sectors. It's done many three capital raises in the last 18 months or so. Last one was a couple of months ago in July, and they've deployed most of that in fairly quick time with a 5.5% yield. They're in advanced negotiations on another 50 million at a 6.2% yield, and they have a pipeline of assets to buy of 400 million. So to see where this share placement is going for. So yeah, interesting times for the company, exciting times, and I'm sure they'll get the listing on the main market and grow even further from there. And we're really excited about that.
Thanks, Richard. Also, sorry everyone, I got the trust name of the new Renewable Energy Infrastructure Trust. It's actually Atara Onsite Energy.